Hi, I'm Phil Grandy, philsgang.com. Phil's Gang YouTube. Welcome to my YouTube channel. And we are in a situation that people don't believe that we're going to drop at least another 30% in the market. Just like in 1929, they didn't believe after they had their first 10%, and a few weeks later dropped another 10%, about 20%, that was going to be it. No, the market in 1929 dropped over 2.5 years, 80%. And we're in worse shape now than we were in 1929 because we can't trust our bond market. Remember 2008 when they introduced QE, okay, financial engineering. It screwed up our bond market. The bond market we always depended on is to identify when to buy and when to sell. The bond market would tell us if yields are going to go up, interest rates are going to go up, or interest rates are going to go down. And we can buy the proper stock that enjoys high rates or that enjoys low rates. Can't trust that anymore. So here's what's going to happen. Now, if you noticed right here in 2018, when we had the stock market crash in 2018, right here, this was the beginning of the crash. I predicted this, by the way, in January of 2018. This happened in the last 2 months of 2018. But guess what? It rallied right back up. Not a problem. After dropping 16 weeks, 21%, it went up 54%. Why? We still had QE. Oh, we had another drop right here, 2020. The market dropped in 5 weeks, 31%. No problem. Just let's put some more QE in. There we go. We'll get it right back up here. But something happened after that 132% rally. Something happened. Everything changed because remember, to get to here, we started in 2008. To get up to here, it was financially engineered. Quantitative easing, zero rates. It stopped. No more QE. No more feeding these corporations. Okay, money, zero rates. And these corporations are in such debt, not like 1929, much worse. Look what's happened. They can't rally. Every time we try to rally without QE, there's no more QE, it's over. And see these two bottoms right here? Draw a line right across here. And this is your potential right there. That's another 30% drop. We already have about a 30%. This is another 30%. Without QE, you're not going to get this rally or this rally. No more rallies. Now, there's another thing talking about the bond market. The bond market was tell us what direction a stock would go, okay, as to interest rates. What we did, because we couldn't trust the bond market, we designed a chart that just follows the money. It's called a sweet spot. If you take a look right here, we get in right here at the sweet spot, we get out right here at the sweet spot. When we short, we get in here, and we get out right here. And what does that do? It lines us up perfectly. If you take the cursor right here, if you line that up, we buy the minute it turns green. Notice over here how your chart, like any other chart, is green and red. Okay, no. This is solid green, just follows the money. And it tells you when to get in. Line it up from here to here, you buy. Boom, goes up. And you get out right at the top, right here, in that sweet spot. Same thing with shorting. You get in at the sweet spot. Remember, see how it's all red? Right there, you get in that sweet spot, right there. Look at that. And then we short it all the way down, and then we get out. So we always get in at the sweet spot, out at the top of the sweet spot. In at the sweet spot, out at the bottom. You can't go wrong. You're guided. And if the money flow is going to change, the chart will turn yellow and give you a warning. It took us 5 years to design this because we can't trust Wall Street and we can't trust the bond market. This tells us exactly what the institutional money is doing. And it will warn us if it's coming out. Check it out. Go to philsgang.com because it works for us. It took us about 5 years to design this. So I hope it helps you too. See you on the charts.